Okay, so with the markets that they've been over the last year, or certainly 2022, I think that plays very much into the Shartru portfolios, the Shartru way, how we build portfolios and why we build them like that. I think it's the most important thing. I thought it'd be useful to get your thoughts on that. Now you've got your feet under the table for 4 or 5 months, and you know how you see our portfolios in comparison to other ones that you see in the marketplace, if you like, and how you see the Shartru way and what you think, you know, how that might benefit advisors and the clients over the next period of time.
Yep, sure. So, I mean, obviously, I mentioned earlier that we run a customized approach for all consulting clients. So we don't profess to be the expert in everything. A lot of time when we take on a client, we'll sort of get a feel for how they do things and how they operate things in terms of their approach to investments and their philosophy. We don't sort of come in all guns blazing and seek to change that. We seek to validate that where it remains true to that style and that firm's approach. And all we do is make sure that all bases are covered, that the education is done well and people understand what they're actually getting themselves into. So for us coming into Shartru, there's definitely a specific way of running portfolios, and that's very clear and distinct at the outset. And in terms of what we've seen is portfolios have actually held up really well year to date. And that's because of that Shartru way. It's very much what we would refer to as an absolute return mindset in terms of the approach. I wouldn't say that's necessarily the target, but that's definitely the approach. And it's more about not giving away as much on the down and not capturing all the up. So, I mean, obviously, every investor tries to capture as much of the upside as possible, which is obviously difficult to do. But the more you gun for that, the more of the downside you participate in. So I think the portfolios have been very much positioned towards protecting on the down. And they've definitely worked in that shape over the last 12 months, particularly calendar year to date, where we see some significant outperformance versus a variety of benchmarks. And that's because of their positioning leading into this period. Obviously, you can't always get timing right. But if you're positioned a certain way through the cycle, you are going to mitigate those downfalls. And I mean, if you're thinking about the end investor, every end investor wants a smoother return rate in some way, shape, or form. And if you can deliver that, then I mean, the end point takes care of itself. And I think that's definitely what we've seen in terms of the portfolios.
Yeah. I mean, I view investment as a journey, right? There's people invest for 20, 30 years. You've got to be able to live through that journey. And trying to smooth that and restrict the downsides, I think is very important in that, to make it a journey you can stay with, if you like. And I think anybody that's seeing portfolios, you know, over history, you know, down 40% or whatever, not many people can stomach that. So I think downside protection is really important, to be available to the upside. And if you don't have that, like we saw in 2008, right, everything gets sold eventually. It depends how far down you go, right? And I know that the world is all about passive and staying invested now, but we haven't been through a 2008, and I'd like to see if that rhetoric stayed the same in a minus 60% environment, etc. Right? And you know, never say never in investing is pretty key, right?
That's